talking about insurance basics. Got it. Jacqueline, before you leave, can you make me the host, please? Just a little bit about myself. My name is Nicholle. I'm a field director with the company. I've been with the company for about 10 years, probably a little bit more than that. My trainer and my field director is Jill Johnson, DD. And I will say, when I first came into this business, I came in dragging. Well, I came in being dragged, and I came in kicking and screaming because my best friend said, you got to come to this convention because you got to hear this great information. And I didn't want to come because I was in graduate school, and the convention was around the same time as I was having midterms. And I'm like, there's no way I can get away to Vegas for a conference when I have to study for a midterm, but I came. And to make a long story short, I fell in love with this company. I fell in love with what it represented. I fell in love with the support system. And I really just took hold of it. I am like a census person inside and out. Like if my best friend decided to quit the company today, I would still stay here because that's how much I believe in the company. So I do come from an engineering background, which means I'm really logical. So, but being in this business is being in the people business. So what I've learned over the years is how to be more personable, how to have a lot of care for people, which I always had, but sometimes being logical, I forgot, and sometimes would forget how to show the human side of myself. So I'm really excited. I'm going to go ahead and get started with the slide deck. Give me 1 second to bring it up. I didn't want to do that one. Nope, I was trying to do this one. So this is insurance basics. This is where we're going to get some good information about what it is and the services that we provide. So I want to start off by kind of doing a quick review of what you guys learned in New Agent Training 1. So in New Agent Training 1, you learn that there are 4 steps that we teach our clients on how to create financial strength. So the first one being manage your money wisely. Step 1, don't spend more than you make. I would always say we all know people who get paid on Friday and they are broke on Monday because they haven't learned or disciplined themselves to save for themselves. The second part is managing debt. The number one reason why people can't save money or save for their financial future is because they have too much debt. That debt, meaning credit card debt, is eating up their money at the end of the month. The third one is creating an emergency fund. And at Census, we teach our clients that the minimum emergency fund that is needed is 3 to 6 months of whatever their household expenses are. So if your household expenses, say, are $2,000, then you would need to have anywhere between $6,000 and $12,000 set aside. And then for me, I think the most important one was setting financial goals, because we ask our clients those questions that maybe they've never thought about, or maybe in some way disturb them. Like, hey, at what age do you no longer want to work for money? Never thought about it. Or at what age do you want to, or not age, how much money do you want to have when you retire? Never really thought about it. And so it's really important that we set some short-term, some midterm, and some long-term goals. Step 2, we talked about protecting our income. Every one of us has assets that we value. The number one asset for me is my ability to earn an income. If I can't work and I can't provide for my family, and if I can't provide for my family, then that means that my family is not going to be thriving and doing well. And so protecting my income, or your income, or the people that you love and value the most, is making sure that if you get sick, there's still income coming in, or if you pass away, there's still income coming in to take care of the people that you love. Then the third step is accumulating assets, where we learned about the effects of inflation, the power of compound interest, the effect of taxes on our money, and really the effect of risk. For me, the effect of risk was a big one, because I didn't understand that, You know, every time the market goes up, that's great. But every time the market goes down, the market has to perform almost 50% better than what it lost just for you to break even. And when I saw that, you know, even with my own money, because when I first came into this business, guys, I did not open my 401k. You know, when the housing market bubble burst, you know, I lost so much money in my 401k. It was a 201k. And the effects of risk, if I had understood what that meant and the effects that that would have had on my money, I probably would have made different decisions. And then step 4 is preserving your legacy. And so, you know, our understanding and our frame of thought is that if you master, not even master, if you just do, let's say 80% of step 1, step 2, step 3, you know, you create the discipline that by the time you are old and you're ready to pass on, that when you pass on, you leave a legacy to the people that you love the most. And the reason why step 4 is important is because you don't want your legacy to be taxed. You know, all of us are familiar with the artist known as Prince. And when Prince first died, you know, I don't know what his estate ended up settling at, but I know at the time of his death, his estate was valued, so to speak, at $300 million. But do you know that even before that 300 million could even be decided, how much of that was going to pass to his family, because he had no trust, he had no will, he had nothing in place. That 300,000 was taxed, federal tax, more than 40%. And then the state of Minnesota turned around and taxed him from a state level another 16%. So what that means is that over 50% of his estate went to taxes. And he hadn't even, and you know, it hadn't even gone before a probate judge. So for us, you know, we think we may not have a lot, but honestly, whatever little bit you have, we don't want it going to the government. We want that, what we've worked hard for, to go to the people that we love. So the one big difference between the truly wealthy and ordinary Americans is that the wealthy understand their money matters. And that's what we hope to share with our clients when we're sitting down with them. So there are 4 quadrants to saving. And so I'm just going to randomly pick on somebody. I'm going to ask Oscar, because you were the first person on when I logged on. If you had $100,000 of discretionary money, which of these 4 quadrants would you put your money in? Oscar, you're muted.
I said, getting basic on the information that I'm getting right now from the last couple of minutes with you guys. Thank you to open my mind. I definitely would go for insurance companies. You know, the stocks markets I tried and was very disappointment. The bank, actually, they would never give me any incentive annually. And for many years, I give up the idea. And real estate, well, you know, I tried before. I sold a house, ex-wife, but, you know, it was not my thing. But insurance company, the way you put it on the papers, the way you taught me how to understanding and comprehending these factors, how to preserve your money and how to make more assets, insurance companies, ideally.
And I'm glad that is a good answer. But think about if you had never been introduced to the information before and you were given the same $100,000, not knowing anything, where would you have put your money?
Well, I mean, I probably would have it on the stock market as a mistake that I made before. That would be the most common thing that people would think without having any information.
Absolutely. Thank you,
That's
Oscar.
what I did.
No, that's right. And that's why it's so important that we provide a basic understanding of money. You know, with all of the education that I've had throughout my lifetime, master's program, I've taken graduate level finance classes. Nobody ever taught me personal finances, and nobody ever taught me, you know, what the pros and cons of putting my money in any of these institutions was. So when we think about a bank, the bank is safe and it's convenient. However, the interest rates that it offers to its customers is so low that you don't make any money. You know, if you remember in NAT 1, you guys learned about the rule of 72. Let's just say the bank pays you 1%. Well, 1% goes into 72 times, which means that if you put your money in the bank, it could possibly take you 72 years to double your money. So I always say the bank is a great place to have your emergency fund, but it's not necessarily the best place for what we call long-term growth. Then you have the real estate. And the pros of the real estate is that it is a tax deduction and it is a possible asset, right? But the cons is that it's long-term. Most people who buy real estate, it takes 30 years to pay off a house. And it is a liability because think about it, if you needed to pull $100,000 out of your real estate, is it easy to do? No, you have to go through a loan process. You have to qualify for that loan. You have to be in good standing with your credit report. You have to have some income coming in. So it's not easy to pull money out of real estate. And then of course you have the stock market, as Oscar had alluded to. Yes, it's the pros is when the market is up, you have a potential to make a lot of money. But what happens when the market goes down? Your money, 100% of your money is at risk, high risk. And then when you come to insurance companies, there are 4 things that are pros about that. One, it offers protection against the downside of the market. It offers cash accumulation. It offers tax advantage. It offers estate planning. But the cons is that there's a cost of insurance. Anytime you purchase insurance, the cost of insurance is always going to be a factor. But not only that, when you invest in life insurance or an insurance product, it's long-term. It's not for a quick turnaround. You're not going to put money in an insurance product and expect to get a big return the following year. So you have to be willing to invest the time that it takes for that money to grow and to mature. And so another question that I would get from a lot of my clients, especially ones that are not familiar with using life insurance as a way of growing their wealth, is how can we trust insurance companies? And I can tell you based on this, it says what is called a state guarantee fund. And that fund is administered by the United States to protect policyholders in the event that an insurance company defaults on the benefit payments or becomes insolvent. It doesn't happen, guys. Insurance companies are required to have enough funds to pay out all policies, plus they're required to have a reserve. So unlike back in the 1920s or whatever, when banks were failing, people were putting their money in the banks and going to the bank the following day and their money would be gone. Well, that doesn't exist with insurance. And so you'll see the chart over to the right where it says from 2016 to 2020, it's showing you the millions of dollars of claims and benefits that have paid out. And I will tell you, as an agent, the biggest, I won't say the joy, but the biggest reward that I've had being an agent is delivering a policy to a beneficiary whose loved one thought enough about them to name them as the beneficiary on their policy. Even though it was a sad moment, it really gave me a lot of joy to bring some type of comfort to that family when presenting them with that. So just know with confidence that every single policy that you put in place, every state, doesn't matter what state you're in, has this reserve, has this trust. And you can tell your clients with confidence that their money is safe. So now we're going to look at the 3 major financial industries. So you have the banks. And then with the banks, there are 10,000 banks across the US. There are 8,800 investment companies across the states. And there are 2,000 insurance companies across the state. And the numbers underneath represent the amount of funds that are in each of these institutions. So a bank has 5.7 trillion, investment companies hold about 8.8 trillion, and then insurance companies hold about 4.5. Now, first glance, when you look at this, it's human nature. We go for the big numbers. And we can see that under investments is 8.8 trillion. So you may think, wow, that's like the best place for me to put my money at, because why? They have the largest share of the money. And I would say to you, no, we would have to be very careful in how we look at that, because if I take that $5 trillion and divide it into all 10,000 banks, that really means that each banking institution only holds about 570 million. Each investment industry only holds about 1 billion. But then you look at the insurance. So even though we are small in numbers, we actually hold more money per insurance company than the investments or the banks. We hold 2.25 billion in each institution. So that says a lot. We may be small in numbers, but we are mighty when it comes to our purchasing power. So now we're going to move on to the financial foundation. Now, I don't know, I've never worked in construction, but I can tell you, I do know this much. You cannot build a house on shaky foundation. When a house is being built, the first thing that is laid is the foundation. And guess what they're looking at? They're making sure that the foundation is level. Because if you build a house on an uneven foundation, that means that that house is not sturdy. That means that as soon as a strong wind comes or a storm comes or any type of weather that can cause any type of damage, the structure of that house is going to fall down. Well, the same is true about our financial foundation. And so the first layer of foundation for our financial is proper protection. Like I said before, we want to make sure that in the event that anything happens to us or to our clients, the proper protection is needed against disability, against health, life, and income. We want to make sure that we protect those things. The next layer is managing debt. We want to make sure that our clients understand that there's good debt and there's bad debt. The way I define it is to say good debt puts money in your pocket, bad debt takes money out of your pocket. And you want to make sure that you have more money coming in than you have money coming out. And then the emergency fund, which we kind of went over before, having 3 to 6 months of your house income. And then investments. Investment is last because investments are risky. So we want to make sure that the smaller part of our house is the investment part in terms of the risk. So investment, asset accumulation, maybe our children are investment, right? We're investing in their future. We're investing in their education. Our home is an investment because maybe we are doing upgrades such as landscaping and remodeling kitchens and bathrooms and so what. And maybe we're buying more investment property. So this is the foundation that we want to paint when we're sitting down with our clients and letting them know that the main foundation is having a proper protection. And that's why this class and the information that we're sharing with you is so important, because unlike myself, I did not know. The only proper protection I had was through my employer. And if I were to have lost my job or been laid off or retired prior to getting this information, I would not have that layer of foundation, that proper protection. So looking at this picture, which would you prefer? I'm going to ask this question of somebody. Look at the picture on the left. We're going to call it picture A. And then look at the picture on the right. We're going to call it picture B. And you'll see that one is very simple. And then on the right, you'll see that one has all these bells and whistles. It has all kind of little things on it that I wouldn't even know what they do because they look so odd and unfamiliar to me. But without knowing what they are, which one would you choose? And I'm going to call on the first person that I see, which is John.
A.
You would choose B? Why?
I would choose A.
You would choose A?
Yeah.
Why?
Because it's simpler.
Yep.
I mean,
okay, thank you, John. No, I appreciate that. There's no right or wrong answer. I'm trying to create a concept for you, because when we think about life insurance, we have to understand that there are simple policies and then there are more complex policies. And simple doesn't mean bad. Simple just means different, and you have to understand what do you get with simple versus what do you get with complex. And so that that is really the reason why I want you to kind of see the difference. And it's going to make sense in a minute. So I'm getting there. I'm going to get to the point. There are 4 functions of life insurance, guys. 4. The first function of life insurance is protection. Never forget that. To protect a person's life. You know, we have insurance on everything. If you own a cell phone, you have insurance on your cell phone. If you drive a car, you have insurance on that car. If you own a home, you have insurance on your house. But remember what I said in the beginning. Our greatest asset is us. It's you. You are your greatest asset. So we have to protect ourselves. So that is the first layer of, or the first function of life insurance. The second one is cash accumulation. You know, when we talk to our clients, we're explaining to them how does interest work? How can they grow their money without losing it? Where can they put their money at where it grows and gets the maximum growth without any loss? Very, very important. And then 3 is we talk to our clients about tax advantage. You know, we talk to them about the differences between tax now and tax later and tax advantage. What are the differences between pre-tax vehicles and after-tax vehicles? And then finally, we talk about estate planning because we want to make sure, you know, from the first class and from learning, you know, the steps to creating financial wealth, that we want to make sure that whatever we have earned, we want to make sure that we preserve that. And the way we preserve that is making sure that we have proper things in place and creating an estate plan. So when we talk about that, even though we as agents don't do estate planning, we definitely recommend it for people who have assets. And so how much of their assets does an individual or family want to pass on to their family or to their loved ones? You know, how much of a death benefit do they want to leave that's going to provide an impact to their loved ones? So there are some uses and some benefits to life insurance. I have to say this is probably one of my favorite parts of doing this particular class, because there are some concepts, not really concept, but there are some benefits of life insurance that I know I definitely didn't know and didn't understand. And so I hope that it will be beneficial to you. The first one is income replacement upon breadwinner's death. And so I tell people all the time, you know, I'm married, I have kids, but the life that I have built for myself, I didn't build by myself. I built with my partner, I built with my husband. And the life that we built takes 2 incomes. And so if he dies, heaven forbid, I need money to continue the lifestyle that I have, right? I need to be able to pay my mortgage. I need to be able to pay my bills. I need to be able to be in a position to be a blessing to my children. And so it works both ways. We want to make sure that we have each other's back when it comes to that. To prepare for college expenses, who knew that you can use life insurance as a way to save for your kids' college? Didn't know. You can use life insurance to pay off mortgages, business, as well as personal loans. Tax deferred versus tax advantage concepts. To buy out deceased partner share with a buy-sell agreement. So guys, what this means, let's say there's a business and that business has 2 business owners. Business owner A and business owner B. Let's say they're 50% shareholders of that business. So business owner A says, hey, if I die, I don't want to be in business with your wife. I don't want to be in business with your kids. So we're going to do a buy-sell agreement, which is done through an attorney, and they assess the value of the business, and whatever the value of the business, they cut it down the middle because they're both equal partners. So let's say the business is worth $1 million. So if I'm going to buy somebody out of $1 million business that I'm a 50% shareholder of, that means I need to get a policy that's valued at least $500,000. So in the event that one business owner dies, the buy-sell agreement says that life insurance benefit is going to pay the family to buy them out of the business, so that as myself, as the remaining business owner, I am now the sole owner of that business. And as I'm talking to you about this, I want you to be thinking about people that you can be talking to, because as we go through this process, you guys are going to be doing your top 100. You know, who do you know who's married? that can benefit from an income replacement? Who do you know who has children that can benefit from a college plan? Who do you know who's a homeowner that needs to be paying off a mortgage? Who do you know that is a business owner who has business partners that could benefit from a buy-sell agreement? The next one is to replace business loss from a key person's death. You know, Steve Jobs was the face of Apple. You know, I'm pretty sure Apple had some type of business insurance on him so that when he passed away, they could get the proceeds. What do they use the proceeds for? They use it so they can groom the next person. They may have to groom 2 or 3 people before they get the right person. I've only done one key person's policy in my census career, and it was for a paper company, and the wife and her husband ran it, but the wife inherited the business from her father, but she didn't know how to run the business. So she was paying the general manager to run the business for her because she didn't know how to run the business. And so we put a key person policy on her general manager because, like she said, if he dies or gets sick, I need money to replace him, meaning I need at least 5 years of his income so that I can, you know, I don't have to worry about the business or, you know, paying this person. I can just use this money. So I want you to think about that as well. Grandparents and parent gifting plans. You know, how many of you know people who are grandparents? I'm a grandmother. We love doing stuff for our grandbabies. You know, we're perfect group of people to target. Group life as an employee benefit. Do you guys know that the turnover rate for most small businesses is very high? And one way that a small business owner can not only attract employees, but maybe retain their employees is by offering them some type of benefit. Why not offer group life as a benefit to that small business owner? Living benefits, which we're going to get into a little more in detail. So living benefits, never heard of it before I came to this business. Matter of fact, when I first came into this business, they weren't even selling policies that had living benefits in the state of California. So my first IUL that I bought when I first came into this company doesn't even have living benefits. I had to go get a second IUL, only because the first one did so well. I refused to get rid of it. Even though people are like, you should trade up. I'm like, nope, that thing has made me so much money. I'm not getting rid of it. But anyway, living benefits has a couple of things. It means accelerated death benefit. An accelerated death benefit means that if you have a life insurance policy, and let's say the death benefit is $100,000, if you get sick, the insurance company will accelerate it to you while you are alive. And so there are 3 ways that you can accelerate that death benefit. One is if you are diagnosed with a terminal illness. Terminal illness means that you have anywhere between 12 months, 18 months, or 24 months of life expectancy. Doesn't mean that you're going to die, but it just means from a medical perspective or a medical standard that type of illness has this type of life expectancy. The second one is a chronic illness. Chronic illness means that you cannot perform 2 of the daily activities over a period of 90 days. Dressing, eating, bathing, toileting, transferring, incontinence. If you can't do 2 of those daily activities, you will qualify for chronic illness. And then a critical illness is basically any diagnosis that follows any of these, and there's a lot: cancer, stroke, heart attack, renal failure, major organ transplant. Every company has different critical illnesses, guys. So like the products that we sell, not to get into product knowledge, but F&G offers some critical illnesses that are limited, whereas Emeritus offers a whole slew. I think there's like 15 triggers of critical illness. And so when we're dealing with our clients, you know, it's going to be very important that we ask questions. I would say if I can impart any wisdom to any of you today, is get really good at asking questions. The more questions you ask, the more information you're going to get. And the more clarity you're going to have on how to move with that client, or what to recommend to that client. So when it comes to having a critical illness, it's very important that you understand that every single day or every 40 seconds in this country, somebody is experiencing a heart attack. And guess what? They're not dying. 90% of people who have heart attacks, we're not talking about massive heart attacks. We're just talking regular heart attacks. They don't die. Medical technology is keeping people alive. But I can tell you, having friends that have suffered heart attacks, they're not having a heart attack on Friday, guys, and going back to work on Monday. They're off for a couple of weeks. They may be off for a couple of months. So what are they going to be able to do for income during the time that they're not able to work? And yeah, you might say, well, they have a good job. They have really good benefits through their employer, but not everybody has a job. There's a lot of people out there who are self-employed, who are contractors, they're 1099. What about the barber or the hairdresser or the person who works for themselves? If they get sick, there is no benefit package to help them. Having something like a living benefit is their benefit packet. In the US, someone has a stroke every 40 seconds. Just because they have a stroke, and again, not massive stroke, but they have a stroke, they're not dying. 72% of them are living. Again, what do? Approximately 39.5% of men and women will be diagnosed with cancer at some point during their lifetimes. Cancer today is not like it was in the 1970s. In the 1970s, they wouldn't even say the word cancer. They would say they have the big C. But now, because people are being diagnosed with cancer and they are beating it and they are surviving. 67% survive having cancer. So again, people who have cancer, even though they survive, it's not like they get diagnosed on Friday and they're back at work the next week. Very few people are going to work when they're going through chemotherapy. Very few people are going back to work when they're having to have surgery to have cancer removed. And so living benefits, I'm very, very passionate about. I have delivered 2 living benefit claims. I actually had a client of mine who late in life got a policy. She got a $200,000 policy that she only had for 5 years, guys, 5 years, was diagnosed with stage 4 cancer. She did not survive. She did not survive. But what she did is she was able to draw down her living benefits. She didn't draw all of it down though. She drew enough of it down to the point where not only did she retire, but she was able to have her son and her sister take a leave of absence from their job. So, and she paid their household. Like whatever money was going into the sister's household, she paid that. What was ever going into her son's household, and he has young kids, she was paying that so that they could do what? Take care of her, take her to and from the doctor and make sure that she was getting the medicine and she was eating the right foods. And then 2 years after her diagnosis, when she died, we were able to present the family, who was very, very, very appreciative. We were able to present that family with a death benefit, with a final check. And so when I say, I've had some rewards, even though they've been sad, but nothing was more rewarding than being able to present that to the family and knowing that I was a part of making that happen. 2/3 of people who file bankruptcy cite medical issues as a key contributor. And not only that, I believe, I want to say, and don't quote me, do your own research, but I want to say like 60% of people whose houses go into foreclosures, it is due to medical issues. Because again, if you can't work, you can't pay your bills. And if you can't pay your bills, you can't keep a roof over your head. So very powerful stuff, guys. And then what most people do not realize is that their health insurance doesn't cover everything. Oh my gosh, that is so true. Maybe about 15 years ago, yeah, 15 years ago, I had surgery. And I promise you, I asked the doctor, like, how long am I going to be in the surgery room? An hour. But they have to book the surgery room in 4-hour increments. So even though my surgery was 1 hour, I had to pay for 4. So I ended up, my bill was $30,000 for a 1-hour surgery. And my copay out of pocket was $5,000. $5,000 for $30,000. I'm like, this is ridiculous. So I say all of that to say if that was, 15 years ago, I can only imagine how much it costs to get sick today. You get sick today just because you have health insurance. Don't think you're not going to have some serious out-of-pocket expenses that are associated with it. And then out of those that filed bankruptcy, look at this, 80% had health insurance. I am not surprised. So there are different types of life insurance. This little cute picture kind of depicts in a way the different types of life insurance, which we're going to get into. This is saying, hey, I have some options when it comes to life insurance. I can buy the life insurance that is like parking a car for $5 on the street. I can buy the kind of life insurance that's like parking my car in a garage, which is $10 a day. Or I can have the ultimate premium car parking service, which is $20 a day. If I park my car on the street, there's zero return. But if I park my car in the garage for $10 a day, I'm going to get my $10 back. And then the premium is I pay $20 for the premium parking, and whoa, I double my money. That's kind of the thing that life insurance I'm going to be showing you is going to lead you to. So the types of life insurance is basically only 2 types, guys. There's term life and there's permanent life. And the best way that I like to describe it is term life is like renting the house. If you go rent the house across the street for 10 years, what happens at the end of the 10 years when the landlord says your 10-year term period of renting my house is over and he kicks you out? Do you get any of your rent back? None, zero. You don't get a dime of it back because you were just renting it. It was for a specific term period. That's term life. Permanent life means you, guess what? You own the house. And what happens when you own a house? You build equity in that house. And that equity, you get to do what to? You get to access it. That's the difference between owning a house and renting a house. That is the difference between owning a term policy and earning a permanent policy. You own it. It becomes an asset for you. It may be something you're paying out of pocket today, but at some time in the future, you'll be able to draw money from it. Within the permanent life insurance, there are 2 types. There's whole life, and then there's universal life. And then under universal life, you have flexible UL, variable UL, and then you have the indexed UL. So we're going to get into some of the pros and cons. I'm not going to go through all of these, but I will tell you the advantages of term insurance is that it's inexpensive, it's cheap. So you guys saw the X curve, in NAT1. The X curve mean when you're young, you don't have a lot of money, but you have a lot of responsibilities. Maybe you're young, you got a spouse, you got some kids, you're a new homeowner, but your money is not right. But you need a lot of protection because you have a lot of responsibilities, right? So having a term policy makes sense because you can get, if you're 25 years old, you can get $1 million term policy for under $100. So, but the problem with having a term is that it has an expiration date. Remember, we said it's like renting the house. How long are you going to rent the house for? You're going to rent it for 10 years, 15 years, 20 years, 30 years, but when it expires, is over with. And if you try to keep a term policy after its expiration date, it is crazy expensive, crazy, crazy, crazy. So that's one thing about it. Now, don't get me wrong. I have a lot of term policies. When I came into this business, I got an IUL, I got GUs. Like I try to buy policies with every company that we represent. That's me. That's my personal preference, because when I talk about a product, I'm talking about it not just as an insurance agent, but I'm talking about it as a consumer to say, I have that product. So I have a lot of term product because for me personally, this is Nicholle speaking to you all. My IULs are for me to build my cash value. My IULs are for me to accumulate my cash. But if I get sick, I don't want to use my IULs because they have a specific purpose. So if I get sick, I'm using my term policies to cash out because they're cheap. It's like borrowing somebody else's money at a really low cost. Then you have whole life. And so the advantages of whole life, and I want to explain something to you. Insurance evolves. So as I talk about whole life, I need you to understand that whole life is like the grandfather of permanent life insurance. So a lot of times when you're out there talking about insurance to people and you say permanent insurance, most people, especially older people over 50, they're going to automatically think whole life because they haven't been taught and they haven't been introduced to the newer concepts of permanent life insurance. So whole life has been introduced long time ago. Some advantages is that it has a tax-free death benefit. If funded properly, it will provide protection for life. If funded properly, premiums will not increase, and whole life can accumulate cash value. The downside is that whole life tends to cost a little bit more, and the premiums are not flexible. And the rate of return on a whole life policy does not, in most cases, outpace inflation. Then whole life came on the scene. And remember, I said life insurance evolves. The next type of life insurance was universal life. And I'm just going to click through all of these. So we already talked about whole life only brings about 3 to 4% rate of return. But then under universal life, you have 3. So the first universal life was a fixed UL, which means that it had a fixed rate of return between 4 and 5%, which is a low interest rate. Then after that came variable. Now you have to understand, when variable life came on the scene, we are not, first let me back up. We are not licensed to sell variable ULs. You have to have a Series 6, Series 7 license to sell variable life because that money is being actively managed in the market, which was really popular when they first came out because the market was returning some crazy high rates. The downside is when the market turned, a lot of people who have variable universal life lost a lot of money because their money was actually in the market, which means that it went up and down with the market. It ebbed and flowed with the market. So it was very risky. And then the newest type of universal life, which is what we are currently in, is the index universal life. And the index universal life has minimum guaranteed safe return. What that means is that when the market goes up, your money goes up. But when the market goes down, there's a floor, and that floor is 0, meaning whatever you've earned in that calendar year, you won't lose. And so these products really do have between an 8 and 10% rate of return. I will tell you, remember I said my first IUL that I bought with this company didn't have living benefits. I still have it to this day. And the reason why I have it is because my first 3 years of having it, I was earning 18% rates of return on my own personal policy. That's why I believe in what we do here, because I have seen it for myself. I used to walk around with my annual statement because I would show people, hey, did you know that you can get these really high rates of return? And so if you remember, we talked about the index concept. You have this black line, which represents a fixed account. This blue line represents the market. So if you had a VLU, a variable universal life, then your money ebbed and flowed just like the market. But when you have the IUL says when the market goes up, your money goes up, but when the market goes down, what you've earned locks in and you stay locked until the market resets and then you go back up. For me, this was so powerful. And if you look at the market today, you know, you can see this is the S&P 500 from the 1980s. It's pretty flat. And you can see where we've had some major falls. We've had some major falls here. This was the .com. We had another major fall here, 2009, which was the housing market bubble burst. And then we had this unprecedented growth, right? And then you have this right here in 2020. This was when COVID hit, and then it started spiking again. And this is kind of where we're at now in 2023. So as you can see, you know, there's no real protection against the downside of the market. And so we really have an opportunity to impact change in our communities. Whether that's the community of our families, of our culture, of our workplace, of whatever organizations you are a part of, because we have to get the general information out that people don't have to be subjected to these ebbs and flow of the market. They actually can put their money somewhere where it is protected. So how do we set up proper protection? You know, I will say after you guys, you know, first of all, after you do your own personal PFC, which you should do, it's going to be very important. You yourself will be your first field training. You yourself are your first field training. Get with your trainer and say you want to do your personal financial checkup. The financial PFC is the roadmap, is your financial roadmap. It's going to answer a lot of questions. It's going to help you understand your own money DNA. So as you're sitting down with your trainer and you guys are sitting down with your friends and your family, you're going to help them understand their financial, their retirement, their family goals. How do we do that? It's a simple formula. And I want you guys to write this down. Do it on yourself. Do your own dime. Dime stands for debt. The D is for debt. How much debt do you have? Debt is credit cards, student loans, personal loans. Income times 10. It's not always times 10. If there are children in the house that are young, that means that, you know, let's say they have a 1-year-old, they don't need that. They need enough income more than 10 years. They're going to need income for 18 years. Or maybe it's two married people who are high income earners already. And maybe they say, I only really need 2 or 3 years of their income because I got it. I make my own money. M is for mortgage. And then E is for education. And we say the minimum is $100,000 per child, but the reality is that's a conversation you have to have with the parents, because education tuition typically goes up 7% a year. So $100,000 today for a child that's not going to be going to university for another 10 years may be a different amount. But you should do your own dime and have an idea of how much proper protection do you need for your own self and for your family. And so going back to understanding your tax timing, you know, we talked a little bit about this. I'm not going to go over it, but tax now is, you know, basically things that the bank offers. Tax later are what we call tax deferred plans, which means that you don't pay the money, you don't pay the taxes on the money going in, but you pay the taxes on the money going out. And then under tax advantage, look at there, cash value life insurance. Basically, you use money that you've already paid the taxes on to fund these vehicles. So it's not just Roth IRAs, Roth 401ks, 529 plans, health savings accounts, but cash value life insurance. So I want to go through this. And I know I'm kind of running, I got 10 minutes. So I want to show you why it's so important that we diversify a portfolio. So on this side, you'll see there's Grandpa A, and then there's Grandpa B. And you'll see Grandpa A is getting money. He's collecting his retirement. He's collecting from a 401k, rental property, traditional IRA, and Social Security. But Grandpa B, you'll see that he's collecting from life insurance, you know, that tax advantage, a Roth IRA, tax advantage, a non-qualified annuity, and Social Security. But if I look at the taxable income, because they have the same amount of money, but they have them in different products. Grandpa A has more of the tax later vehicles. Grandpa B has more of the tax advantage vehicles. So Grandpa A, He's being taxed 100% on his 401k, 100% on his rental property, and 100% on his traditional IRA. That puts him in a higher tax bracket. And because he's in a higher tax bracket, now he has to pay taxes on his Social Security, which is $1,000. So at the end of it all, when you look at Grandpa A's take home income, it's $6,460, which at the end of the year, at the end of a calendar year, is $77,520. Not bad, but it could have been so much better if he had known about tax advantage products like Grandpa B. Grandpa B pays 0 taxes on life insurance. He's going to get that $2,500 tax free. He's going to pay 0 on his Roth IRA. And on his non-qualified annuity, the taxes he's paying is not taxes on his principal, but on the interest that it grew. So when you look at his tax bracket, it's low. It's only 12%. So because his tax bracket is low, guess what he doesn't have to pay taxes on? His Social Security. So his take home is $7,200 a month. And at the end of one calendar year is $116,400. So I hope this kind of shows you that how we diversify our money between tax now, tax later, or tax advantage really makes a difference at the end. Any questions about that? Because I know that was a lot.
I just had a quick question on the last skit that you did regarding the Grandpa B. If they're all tax advantage and the Social Security is non-tax as well, wouldn't he take home $10,000 a month instead of 75?
You're probably right, and that might be why these plus signs are here.
Oh, okay. Okay. Just wondering. Okay. Sorry about that. Go ahead.
No, you're fine. You're fine, but you're right. It should be more. But I guess the person who put the slides up just said we're going to put the plus signs and let you guys do the math on your own. So thank you, David, for that.
Got it. Thank you.
So I'm not going to go over this slide again because we've kind of gone over it before, but I do want to spend the last few minutes. I have 7 minutes showing you what an illustration looks like. This is an actual illustration and showing you, every time we sit down with a client, why it's so important to do a PFC and a dime, because every client is different. Every client's wishes, their wants, their goals, their dreams are all different. So in this case study 1, we're dealing with a child. This is a juvenile policy. And we're dealing with a 3-year-old. And the parents are putting $4,200 a year into this policy. And what you'll see here when I come down to the years, when this child is 19 years old, they're headed to college. The parents are now going to draw down $20,000 a year for 4 years. So you can see up until that point, they put in $84,000 into this policy and they're going to pull $80,000 out. But if you follow my cursor, you'll see that they have money in their account. Their money in their account is still pretty good. You'll see when I pulled $20,000 out, their surrender value went down, but their account value stayed the same. And so the beautiful thing is that their money is still making money. Oh, I forgot about that little thing there. And maybe when that said child that was 3 is now 36, and let's say that said child now wants to pull out $30,000, maybe to put down as a down payment on a house. Well, they can because they have money in their account. And then continuing on, maybe at age 43, that said child who is now 43 years old says, at age 43, I want to start a business. And so they pull out $100,000. So you can see over here under plan premium outlay, they've paid $168,000 into this policy. They've pulled out more than what they've put in. They've pulled out $210,000, but they're still not done. Then when that said child turns 66 years old and decides they no longer want to be paying the $4,200 a year into this policy, they're able to draw down $148,211 in income. Essentially, over the course of them having this policy, they put in a total of $260,400 and pulled down $2.8 million. And even if they die at age 86, they're still going to be able to leave $600,000 as a death benefit, as an immediate estate plan to the people that they love. Very powerful. The second one I want to show you is a male, 45 years old, who's an entrepreneur. So as an entrepreneur, let's say he has a lot of investment properties, doesn't know what to do with his money, sets up a 7-year pay. He puts $60,000 away for 7 years. At the end of the 7th year, he decides he's not going to put any more money in the policy, but he owns the policy. Remember, guys, when I said that our policies are assets, it's like owning a house. So he basically outright paid for it over a period of 7 years. But if you look over here at the money, this is his money. And he can now use this money. He can pull this money down to do what? Invest in other properties. He can actually do what we call infinite banking. He can now start doing what they call hard money loans to family and friends. And those people no longer have to go through the traditional banks to get a loan. They can go to him and pay an interest and make money. So there's a lot of things that this person can do with the money, or they can simply do nothing, put the $420,000 in like they've done here and wait until they turn, even though it says here at 56, I'm going to have your eyes come down here to age 65. And at age 65, the $420,000 that they put in is now worth $1 million. And if they choose not to take the money out and they die, they create a $2 million estate for their loved ones. And I think I have one more to share here. This is at age 75, 1.9 million in account value and 2.9 million in death benefit. So we talked about, and we're rounding it up, guys, we have like 2 minutes. So the last thing I want to talk about is how to create generational wealth. And in this example, let's say a 20-year-old, I'm a grandparent. I gift my grandchild who's 20 years old, $20,000. And I say, you're going to put it in an IUL. And they put that $20,000 in. And I tell them, you have to add to it $100 a month for the next 45 years. So what happens over 45 years, that money's going to grow to $1.5 million. So now that granddaughter of mine is a mother herself, and she gives her 20-year-old half of what was gifted to her, which is $766,000. And she tells her, now, because inflation is higher, now you pay $200 a month into this policy for 45 years. Now, the second generation is going to be blessed with $35 million. And then the third generation says, you take half of that 35 million. Now you take half of that and you put it in a plan. And then you do the same thing for the next 20-year-old. And then you have them pay $300,000. Now for the third generation, they're going to have $814 million in generational wealth. And this is just to show you that wealthy people in America have been using life insurance as a generational wealth building tool. So my time is actually up. I am at 9:59. I need everybody to turn their cameras on so that I can take a picture, and then I will entertain questions for like 30 seconds. So cameras on in 1, 2.
I apologize, my camera's not working right now.
Okay, I'll make a note of it. 3, Shino, can you turn yours on? And I'm Herb, you can turn yours on, that would be great. Okay, waiting for I'm Herb. So I'm on the count of 3. 1, 2, 3. Yay! You guys made it through. So as we go, if you have any questions, shoot them out now, because I think we're right at 10 o'clock.
Thank you, Nicholle, so much. Great training.
Thank you.
You're welcome. Have a great night, guys.
Thanks for the training session.